Dumebi Oluwole now right here in the studio. Great to have you, Dumebi. It's been a while.
Thank you.
Yeah, the same prices still dropping, you know, after the record highs we saw, talking about the oil market now. And it looks like that surprise output cut by OPEC is not doing much for the price at this point.
Yeah, I mean, it did have its initial market reaction, which was, you know, what everybody had expected to see. We saw oil prices increase, and we already know why OPEC is doing this. They're just trying to keep prices at least, you know, at $80 per barrel. And remember that most of the countries, you know, in OPEC, apart from Saudi Arabia, and, well, not just OPEC now, OPEC Plus, apart from Saudi Arabia and Russia, most of these countries need oil prices higher than $50 per barrel to make a profit, to generate substantial revenue. Even though oil prices are not as high as $100 or $120 per barrel, it is still sufficient for countries to generate substantial revenue if they are selling enough to the oil market. But recently, what is currently driving prices is the expectation that the U.S. Fed might continue its rate hike. So the U.S. Fed is is going to meet soon, and the expectations are that they would increase interest rates by an additional 25 basis points to about 5% to 5.25%, to the 5% to 5.25% range. And the reason why this is so is that the two main inflation numbers that the U.S. Fed, looks at, that is the core inflation, and that's inflation less volatile commodities like energy and food. They look at that, and they also look at the wage index, right? So there's a labor cost index that the U.S. Fed also looks at, and that tracks the rate of increase in wages across the public and private sector. And what that tells you is how fast is income, increasing across the private sector and the public sector. Why this is important is because the more income that people have, the more they're able to consume, and the more that stokes inflation. And the reason why this is also important is because we know the issues that have been happening with the U.S. labor market. It's practically tight. So suppliers or employers are increasing wages just so that they can get more people to come in to work. So these two indexes, or these two indicators for have actually increased. And so the U.S. Fed now it strengthens the U.S. Fed's decision to actually continue with its rate hike. Now, the flip side of this is that it could cause the U.S. economy to overheat. So already we know that an increase in interest rates, what it does is that it increases the cost of borrowing for manufacturers and businesses as well. And this means that credit is expensive. The possibility to expand, your businesses is also expensive, and as such, operating costs will increase, the money that these companies will spend, and this eventually has an overall impact on economic growth and output. So essentially, it's more of like a hard-on decision for the U.S. Fed. So it's like go big or go home.
So it's still going to be that 25 basis points regardless.
Most likely.
Maybe the last one. Maybe the last rate hike for the year.
Well, I mean, it could be. And the reason why it could be is because when we look at the gap between inflation and interest rates, the gap has really narrowed between from where we're coming from. That's in the U.S. now, between last year and this year. At 5%, the gap between inflation and interest rates now is just about 0.5%. So it's really close. But the U.S. Fed wants to take inflation down to its target of 2%. And at 4.8%, inflation is still substantially higher than that. So already their position to increase interest rates is still, it's still strengthened.
Here, ours was also, as close as they're talking about inflation rate
and interest rates. Well, if you look at headline inflation and the MPR, yes, it's getting close. But what the interest rates that's better used to anchor inflation expectations, anchor business expectations, and investor expectations are the interest rates on government securities. And why this is important is because in a stable economy or by economic theory, the expectation is that an increase in the anchor rate should trigger an increase in other interest rates in the economy. So increase in fixed income securities, increase in bond rates as well. So because this is happening, the monetary policy transmission mechanism in the US is really strong. So we're seeing these interest rates also take effect in like mortgage rates, bond rates, government securities. So we know that that's why it's almost easy to say, okay, the US fund rate, and it's easy. But when you really want to check how far inflation, how far a monetary policy is working to cool inflationary pressures, you look at the interest rates of other government securities to see how well this increase in MPR is anchoring, all of this. But in Nigeria, the transmission mechanism is really weak, and why why I say so is because the bond rates, a 10-year FGN bond right now is at 10%. The 364-year T-bill rate is just about 14%. Then you have the 90-day, short-term interest. Short-term interest is still really low, still far below 22%.
Yeah.
So, and this means that the negative real rate of return on investment is high. It's widening, and unfortunately, because inflation actually increased. Inflation increased in March, that also testifies to the fact that there's still that disconnect between interest rates and inflation, or rather, a better way to rephrase it would be to say that the increase in interest rates or monetary policy tightening is still playing catch up to the increase in inflation.
Still playing catch up, even though we've gone so high at this point. But now this, with oil prices going down, at this point, that's putting pressure on our earnings.
Yes.
That's talking about Nigeria. And we've still not met up with that quota, but there's been improvement.
Yeah. I mean, we've been seeing gradual increases in Nigeria's oil production, which is good, although it's not up to what the government is expecting for the year, which is about 1.69 million barrels per day, and still not up to the OPEC quota of about 1.7. So we're still far away from that, but there's still a bright spot. If all the challenges regarding like oil production, the government continues to put effort to curbing like oil theft, vandalism, and we're beginning to see, and we continue to see this uptick in, oil production.
So Nigeria's quota, stays the same, regardless of the output cut we've seen from OPEC, the surprise which takes effect this month. Yes,
and that's because of the compliance rate. So OPEC is, like I said, OPEC is being very conservative, and they're also, it's more of like a scale of preference, right? So we know where to shuffle. So OPEC is looking at where they can shuffle and gain the most. So instead of increasing, so imagine if Nigeria's quota is 1.7. Nigeria has not been able to meet that quota since the beginning, since they gave us the 1.7 quota, and this is almost like, I think, for about 4 to 5 months now. We've had that 1.7, million barrels per day quota. Then you have Saudi Arabia that has consistently surpassed its quota. So what OPEC and its allies are doing is would rather give Saudi Arabia a lot more than tell Nigeria to increase its quota. So what they're doing is just not putting their eggs, in one basket, and ensuring that they're giving the right quota to the right people. Yeah.
Right, and we got some positive forecasts there. We see not just palm oil production, that's forecast to rise about 7%. What are they looking at to forecast that?
Well, I mean, we're seeing like good weather reports in the growing region for Nigeria's palm oil production. So palm oil, I mean, the one that we really use, you can get that, from the eastern part of the country. You also can get that in some states like Ondo. So essentially, because of, it's now like the rainy season, at least we're entering it a little bit, and we're seeing an increase in the it's so basically it's the season, rainy season. It's beneficial to like palm fruits and all of that. And then we're planning to, there'll be an increase in the production of palm oil. But aside from that, we've also seen like an increase in government intervention schemes towards the production of palm oil, and most likely that's beginning to also take effect because palm oil, like other agricultural commodities, the gestation period is really long, so it does take some time before you begin to see an improvement or begin to see the impact of investments in that particular sector and then reap the benefits. Then another thing to also consider is the increase in private investment into that sector. So we've seen the growth in companies like Okomu, Relief. So you see that these companies are investing not only even in the crude oil, palm oil stage, but even in the processed palm oil production. So Nigeria, as of today, is the fourth largest producer of palm oil. That's after Indonesia and Malaysia. But then, we're still net importers of the commodity. And even though the government and the CBN as well, they put palm oil on the forex restriction import list. So that's one of the reasons why we've seen the price, increase over the recent years, alongside other issues like insecurity affecting production and bad weather conditions. But regardless, with this policy forecast, we expect that prices will begin to decline, but it might not be so drastic. The decline might not be so drastic, and that's because of all the underlying domestic issues that affect palm oil production. So remember, I said that Nigeria we do have the capacity to produce, but we don't have the capacity to refine as much and then sell the products to the domestic economy and even export is really low.
So it's the same story with
with
the
a
major
lot of
commodities.
exactly. So smallholder farmers still contribute about 80% to Nigeria's palm oil production. Then you now even go further down the value chain of palm oil processing, and then where you have production of crude palm oil, because that's just the first stage. That's the beginning of it all. You still have refined palm oil, that's RBP. Then you also have refined palm kernel oil from it. Then you also have palm kernel. So there's a whole thing that goes on. So many byproducts. So these are some of the gaps that Indonesia and Malaysia are currently filling in the global palm oil oil market generally. So I don't know if you remember when palm oil prices actually really increased on the in global market last year, and that's because Indonesia was saying they were going to ban.
Yeah, I remember.
They had an export ban,
yes.
A temporary export ban, and that's just shot up the prices of palm oil. So we saw a shift in demand to other oils, other cooking oils like refined and bleached palm oil, palm kernel oil, sunflower oil, and all of that Malaysia as well, sells. So, I mean, this is an opportunity, I guess, for Nigeria to just keep the momentum going, encourage private sector investment into this sector. The current players are really doing well. So clearly, it means that there's room for the market to expand.
And we need more players in there.
Exactly.
All right, let's look at the domestic commodities market now. What's happening there?
Well, we're seeing the impact of seasonality come into play here. So now is the planting season for a lot of these commodities, and we're seeing prices. The expectation is that prices will increase. So commodities like tomatoes, pepper, onions as well, we could see their prices increase in the near term, and that's just because seasonality is taking its toll. There's also the fact that the exchange rate has been quite stable at parallel markets and even the official market, and it's because the CBN has been increasing its intervention efforts, even though we're seeing a decline, a massive drawdown on external reserves. But we're seeing the Naira stabilize somewhat, and this is aiding importation of some of these commodities that we use, so things like tomato paste and all of that. So we could see their prices, decline a little bit. Things like wheat as well. So we could see the price of pasta, noodles, decline a little, right. Flour as well, and this is just because the exchange rate has actually been stable for quite some time now. I mean, we started seeing this stability since the election period, and even up until now, we're still seeing this same stability continue.
We need those prices to come down. So
to just come down, at least
to reduce disposable income.
Exactly.
All right, thank you so much, Dumebi Oluwole. Thank you. It's always great having your perspective.
Thank you so much.
All right, so now we have another conversation coming up. It's still about rising food prices. That's in a moment. To stay with us.
the Dangote Petroleum Refinery is going to be the